Hi everybody, this is Gary Dean with Sentiment Timing, and this is our free technical video report for Wednesday, June 19th, 2019. So we've had a pretty wild market. Things definitely did not go as we were planned, and I'm going to pretty much go over a lot of that right now and what we see playing out, because as far as the time-wise, things, they don't always go exactly on the date, but I'm going to show you why it's still important as far as what we see, what he sees going on. So this is a report back in September 25th, 2018. Now, what we were anticipating was that there was going to be an August top and it was going to be downside into September. It didn't manifest that way. But what would he? It didn't change. And I say this a lot, where even though a time period doesn't, happen, it doesn't change the predictive analytics model. It's not going to automatically turn it bullish if we were looking down or bearish if we were looking up. It's just the time period is delayed. And on this, so obviously the time period didn't go, but what he said here was he still foresees a notable relief rally in November that may be followed by a decent weakness into year end. So let's take a look at what took place. This is November 25th. So he was talking about when the low was as the market was making new highs, even though we were anticipating that this was going to be the drop, and then we were gonna see that head into the September time period. But the thing is that even though that didn't manifest, nothing changed. He still sees a relief rally in November, and it'd be followed by decent weakness into year end. So the time part that we had here didn't work. But this is what happened. Here's November. Here's our relief rally that we had. Here is December. This is supposed to be 26. Sorry. And that was the low. So this is exactly what played out. It was just this time period that was delayed. And if you go back and look, this is exactly when the Fed announcement was. So we're in a very similar time period than we were then. And like I said, even though things did not play out as we did, it doesn't change the overall model. So what he's saying here is that we were not. This week was supposed to be due for corrective, but this day is not for sure. That was yesterday when we had that massive rally off of the Draghi comments, and then we were heading into the Fed meeting today. The market is always right, even with these strange spikes. So, in other words, what he was saying here was that the S&P had no business trading back above 2910, and it was what he was saying is that it retains an overall profile for weakness, but from the existent double top, or even if it did not break down this week, it is strongly preferred. Now, this is what it doesn't this look very familiar from the other report, is the next low is due on, and this is the date that the members have. So again, we go back to this, and this was looking as the market was making new highs. He was saying when the low was. And we have the almost an exact same thing going on. We were looking for weakness. It could have been a possible market crash, and it may turn into some kind of flash crash. We don't know. What we were looking for did not play out on that end, but it doesn't change this. We still have the low date. So it's you can see as far as even the sentiment numbers. If I go back and look, in this is going back to the September 2018. A series of bullish sentiment readings. We had a drop, and then from here we got bullish again. So let's look at the markets now. Here's our series of bullish sentiment readings. We got bearish, and now we're getting the bullish readings again. So things are, they don't follow exactly, but they do mimic. And this has the same type of feel to that, where nobody really has any idea what the market really went up for. There was some talk from Draghi. The Fed did exactly what everybody thought they were going to do, and yet we're 30 points from the all-time highs. And we have the Fed talking about rate cuts, which I explained to the members today. There's something that's just not adding up with this whole equation, because we have an economy that some are saying is the best in history. We have unemployment at the lowest in history. We have the stock market that's 30 points from all-time highs. but yet we have a Fed that's talking about cutting rates. So this is where I'm saying there's something that's underneath this that doesn't smell right, and especially with the move that happened yesterday with it. So like I said, the time period, it was wrong. It did not work out as planned, but it does not change the overall predictive model here, where time wise is still bearish. Sentiment is we've seen extreme bullish sentiment readings, and technicals we're looking for a pullback. But I'm going to go over some other things that is kind of supporting that maybe this isn't going to be the high, even if we get a big drop to the downside. So let me go over let's go over some other things. Short term, we're in euphoria. We know that. Intermediate term, we actually went from kind of anxiety back up to euphoria again. And really the thing that I want to show you is this. This is some of the internal charts that I follow, and this is the McClellan Summation Index. So this is actually going into the beginning of 2018 in February. You can see we had a big drop. Here you can see the MACD on it went down. It turned back up. We had a big spike, and this line right here matches kind of where we are right now and where we were here and here. So you can see that the MACD didn't really have enough time to even turn up like it is right now, as when the markets were all the way back up near previous highs again. So this is what happened after that. We had a big move down, but then came back up and made new highs. Big move down, came back up and made new highs. Now, why am I saying new highs, and why is this? Because this pattern actually has a very fractal pattern look to it, where it looks very similar to the way this spiked right up, and then from there everybody got bullish on the market, and this is actually from this time period we had the drop. From this period we had a drop where we tested these lows. But I keep mentioning new all-time highs, or this isn't the high, and this is the reason why. If we go back into the September time period, this is the advanced decline line, and you can see it's diverging as the S&P was making new highs. This was one of the biggest warning signs of the market that I've seen in years, and from there we saw what happened. We don't have that right now. We have the NIAID that's making new all-time highs. So I do believe that we can come down and test these lows in a very, very fast manner, and then from there come back up and possibly make new highs. But if it does play out like that, what we're going to be looking for is that low to come in on the date. So we're not. Everything we're looking for is usually in a 6 to 8 week time period. So when we look for bit moves, it's not heading into a new bear market or a new bull market. It's what we see that's playing out in the next, say, 6 to 10 weeks, or even sometimes a little bit sooner than that. So let's take a look at our charts and see what they're telling us right now. And again, this was just what I was showing you at that low. We're not really that, we're getting into the overbought levels on the daily chart. But this is really what I'm looking at, is if the S&P, if they can take out these highs here at the 2931, this was a target that I've had when we are in this area here, because I thought we were coming up, and we can close the gap at the 29.44. We have bearish divergences on the 60-minute chart. The bears, they really need to get it through this 29.10 level. But like I said, we're in an area where things are very mimicking back in that September 25th newsletter, where what we were looking for did not play out as it did. But it didn't change the overall dynamics of our predictive analytics model, where things were still bearish on the markets and everybody went bullish on the market. And from there, we saw the S&P drop 600 points. So we don't, I'm not looking, I don't know if we drop 600 points. I'm going to let the market tell me. But what I am saying is this, is that whenever we, do make this top and we get that nail biter, whether it come down and close this gap, or possibly we go a little bit lower than that and come and start closing some of these other gaps. But my point is, once we make that low, I do believe that we come up and possibly make new highs, or we get some kind of divergence in the NIAID before we have things really turn in the market. So we know the low date right now. We're just waiting for this market to top, and when it does, it's going to reverse, and it's going to be in a very fast manner. So I wouldn't be complacent if you're bullish on this market. Just be ready, because when it turns, everybody leaves at one time and we get massive moves to the downside. But like I showed you, I don't believe that we're heading into a bear market right now. I think that once that low is made on Woody's on his low date or low time period, I do believe it's going to be a great buying opportunity, and we're probably going to see the market testing somewhere up at these highs. So with that, let's see what plays out. If things are going to turn, they're going to turn fairly quickly. And like I said, don't be surprised to see us down testing these levels in a very fast manner. But like I said, the low date, what I can see playing out is that once we do turn, a move down, up, and then down again, and then that will most likely bring us into the low date. So with that, have a great night, and I will talk to you guys on the next free video.